Okay, good. All right, so let's go ahead and take a look at the textbook first, and I'm going to supplement it with this spreadsheet you see up on the screen, which is also in posted in e-learning under chapter 9. But let me do this little maneuver. Almost, not quite. So we got to go through this silly exercise. Okay. Can you hear me?
Yes.
Yep.
1 second, guys. So annoying. Really? Okay, looks like I'm going to have to.
Oh, let's see, maybe not. Let's see. Maybe it's coming back. Let's see. Okay, well, I was always told I have a face for radio, so we're just going to go ahead. You can hear me, right?
Yep.
Okay.
Yep.
Yeah. Guys, I'm going to reboot because we lose something. I think it's worth the time to just go ahead and try and fix this. So I'll be back. Okay.
Okay, got that part done. Now let me see. if I can put us in tablet mode without the whole thing going south. Now, let me see if I can get the file opened. This is ponderous. It won't let me put Zoom up. Okay.
That's looking good. What happened?
I think he's still having technical difficulties still.
Oh dear.
Okay. So far, everything that can go wrong is going wrong. It was saying I had no internet connection for a minute there. And I couldn't get Zoom to work. So let's try this again. Okay. Got that. Got that. Zoom seems to be back. Let me share my screen. You can see the book, right? Okay. I'm going to try to do it in a manner that won't crash the whole thing. I'm going to take a deep breath. I'm going to go to full screen. And I believe we are back in business. Okay. Okay. So where we left off, remember guys, last time, as we talked about governmental accounting, we talked about we are going to need to understand the budgetary process. And so we talked a little bit about setting up the budget at the beginning of the year, having estimated revenues, having appropriations, having our budgetary control account. We would open those accounts and then close them at the end of the year. We'd open them at the beginning of the year, close them at the end of the year. Then we talked about actual activity, and we said one of our big jobs is just understanding how the governmental funds use modified accrual accounting, and we have to understand some of the big differences between full accrual and modified accrual accounting. And we basically went through and started talking about taxes receivable and whatnot. And we said that on the balance sheet of the governmental funds, right, the general fund, special revenue fund, debt service fund, capital project fund, permanent fund, we're talking about all of those simultaneously at this point. We only have current assets and current liabilities. Well, inventory is a current asset. And so we're going to have to learn how to account for the inventory. And it is similar in some ways to commercial. However, we have alternatives for recognizing, and this approach works for inventory and prepaids. These options pertain to inventory and prepaids. Okay, so one is the purchase method. Okay, and we're just going to sort of focus on inventory, but kind of keep the notion of prepaids in the back of your mind as well as we go through this. So under the purchase method, you will record the inventory as an expenditure at the time that you acquire it. And then it is not until the end of the year that we will set up the current asset for any inventory that's left. And we will have to set aside some of our fund balance, labeling it as non-spendable fund balance. The other method is the consumption method. This is much similar to what you would use in a perpetual inventory system for commercial accounting, and that you record the inventory as an asset when you acquire it, and then you will record it as an expenditure as you consume it. When we say inventory, let me clarify, I mean like supplies inventory. I don't mean inventory for resale. I mean inventory that will, we're not a commercial entity, we're a government. So we're buying office supplies, something like that. Okay, now you can see they give us the journal entries down here under the two methods and what happens, but I don't know about you, I find journal entries without numbers not very helpful. So what I'm going to do is take you now to that screen I was showing you a minute ago, that Excel spreadsheet I was showing you a second ago. And let's just go through this example using both the purchase method and the consumption method. So now when I talk about inventory, I'm talking about supplies inventory. I'm not talking about inventory for resale. And I say, assume the city of Hayward had $100,000 cash and spent it all on inventory. What would be the journal entry for the purchase of the inventory? Now you look and you can see here that the balance sheet, of course, looks the same under both methods when we have the cash, and we would have an unassigned fund balance. That means that the entity can use those funds however they see fit, of course, within the context of managing this government, this city. Now, when we purchase the inventory under the purchase method, as the textbook showed us, we would go ahead and debit expenditure and credit cash for the 100,000. Now, right after we do that, of course, we would have no more cash, and until we do our closing entries, the balance sheet's not going to balance, but we're not preparing a financial statement at this point, so that's fine. Under the well, let's go ahead and just go through the purchase method, the entire thing, and then I'll come back to the consumption method. Now, what happens as we use the inventory, and I say assume 45,000 of inventory are used during the year, there's no entry. We've already recorded it all as an expenditure, right? So there is no entry. Then what happens? Then we go ahead and we prepare the statement of revenues, expenditures, and change in fund balance, which remember is like the income statement for our governmental funds. I'm assuming no revenues. The expenditures are 100,000. So my change in fund balance, which is like my net income, is 100,000 loss, a negative 100,000. Now, when I go ahead and I do my closing entries, I go ahead and I will debit the unassigned fund balance for 100,000 because fund balance is like retained earnings, right? So I'll debit unassigned fund balance and I'll credit the expenditures to close them. And then I have to set up the inventory for what's left. So there's 55,000 of inventory left. So I debit inventory 55,000 and I credit the non-spendable fund balance for 55,000. So if you were to look at the balance sheet after I've done the closing entries, and it'll be this for both methods, the inventory now is 55,000, non-spendable fund balance has 55,000. Those two numbers always match. The inventory and non-spendable fund balance for inventory, those two numbers always match. They have to have the same number, and that's the case under both methods. Now, if I was using the consumption method, much more like the perpetual method, we debit inventory, we credit cash, we have our balance sheet right after the purchase, the cash is gone, and we have the inventory of 100,000. And at this point, we would have unassigned fund balance for 100,000. And then we go ahead, we debit the expenditure, we credit the inventory for 45,000 as we use it. And then you can see how the financial report would look. But what I want to show you here is actually the during the year adjustments, okay? Because they say no entry is necessary at the end of the year. So I just want to show you the purchase method here. Debit inventory, credit the cash. So now we have that inventory. As we set up the non-spendable fund balance by debiting the unassigned fund balance 100,000 and crediting the non-spendable fund balance for 100,000. So when we do that, now the inventory has 100,000, the unassigned fund balance is 0, and the non-spendable fund balance is showing the credit balance of 100,000. Then we go ahead and we use the inventory. So we debit expenditure, credit inventory, just like you would in commercial. The inventory account comes down to 55,000. We go ahead and when we debit the expenditure, we have the expenditure now. Then we go ahead and we adjust the non-spendable fund balance by debiting it for 45 and crediting the unassigned fund balance for 45. When we do that, notice now that the non-spendable fund balance shows what? Shows the 55,000, which is what we want it to show because it has to match the inventory. And now our unassigned fund balance is showing a credit of 45,000. But when we do our closing entry, we debit the unassigned fund balance, we credit the expenditure. So again, at the end, the balance sheet looks exactly the same as what we saw under the consumption method. Question?
Yeah, are there basically two sets of journal entries? There's the inventory cash, and then there's the thing with the fund balances. Am I understanding that correctly? In the slide you were just on, or in the, yeah, that one?
In the purchase method? Yeah, we're simultaneously, Kathy, updating the inventory and the non-spendable fund balance at the same time. So,
Okay, and this method, right, that I'm looking at right here on this one, is this is the consumption method? This is the consumption method, right? Because you're debiting the inventory immediately when you're purchasing it.
well, unless I got them flipped in my mind, because now I'm.
No, I just wanted to get clear. I just wanted to make sure I understood what I was looking at.
I want to make sure that I have the right label on it because I might have messed up the label. I'm calling that consumption method because I always do that. I always get them twisted. So I'm calling this the purchase method, but this is actually the consumption method, right?
Well, it says purchased inventory, and so that's.
Oh, okay, right.
It says
right.
assume the same facts as previous, but now let's adjust fund
Right, okay.
balance as we go for the consumption method. Okay, I just didn't
Right.
read that well enough. Sorry.
Right. Under the consumption method, to answer your question now, both the fund balance and the inventory account are updated simultaneously.
Got it. Thank you.
Okay, yeah.
Is there any benefit to use one method over the others?
Governmental Accounting Standards Board, GASB, prefers the consumption method, but they don't mind if entities use they allow entities to use the other method, the purchase method, if inventory amounts don't vary significantly between years, because then you're going to still end up, because if you look, the expenditure number is wrong, right? Because on the one case you're showing expenditure of 100,000, the other case you're showing 45,000. But if year to year your inventory, you pretty much buy the same and use the same amount year to year, it doesn't make a material difference. So they allow them to use both methods.
Thank you.
But they prefer the consumption method because it's obviously more in tune with what we're used to in accrual accounting. The key takeaway here, guys, more than anything, is that you have the two alternatives. It applies to what? It applies to both inventory, supplies inventory, and prepaids. And the other important thing is to just keep in mind that you always have to show that non-spendable fund balance for something like inventory, because inventory, you can't spend it like cash. So they call that non-spendable. And if you think you can, spend inventory like cash, try it sometime. Go to the, Safeway and say, hey, I went and bought a 10-pound bag of nutmeg at Costco. Will you give me food for it? And they're going to call the cops. Okay, so you can't, you spend inventory like cash. So we have to put in a non-spendable category. And we'll talk about the categories of fund balance here in a little while. Okay. Okay, good. So let's just go ahead then and let's take a look at, and I want to do something. I'm going to go ahead and do it. Got off to such a rip-roaring start here. I'm afraid I'm a little bit gun shy, but let me try this. When we look in F9, okay, and I think it's page F9, 19. See if I can get there quickly. We're going to come back to all this, obviously, but I just want to show you F9, page 19. Different way. We're almost there now, though.
Are you looking for the fund balance labels or the categories?
No, I'm looking for the example of the balance sheet for the general fund, which I've just about got now. I should have just put it in full screen mode, but I didn't want to because I want to go back to the other page, but here it is. Okay, so when you look at the balance sheet, okay, for the general fund, notice that what the inventory is showing 55,000, and we know how we got there, either using the consumption method or the purchase method. You still have to show the inventory, and then when you come down to the fund balances, you have these different categories of fund balance, and non-spendable for inventories is 55,000, and we know how that got there, either by using that end of the year adjustment under the purchase method, or by tracking the inventory and the non-spendable fund balance simultaneously during the year under the consumption method. Okay. Okay, good. Let's go ahead then and find ourselves back. Here it is. Okay. And go back to full screen. Okay, good. All right, so let's talk about classification of expenditures. Okay, so when we look at our statement of revenues, expenditures, and change in fund balance, we're going to have recommended labels that we can put on our expenditures that will allow users of the financial reports to understand the nature of the expenditure. There's no requirement that you have to use it a certain way. These are just labels that GASB has called out that are available to governments to put labels on their expenditures. Now you look and they give us, these long explanations. And what I'm going to do is just sort of give you, examples. I think are a little bit better than trying to read through that long thing. So let's just take a look. And function or program, you can put next to that things governments do. Okay, things governments do. For example, they have what? They have programs for the elderly, drug addiction, to get you off drugs, not on. Okay, things governments do. Good example might be public safety. Now, sometimes I'll say, does the government keep you safe? And people say, well, no. Well, if you make it home tonight, then I guess they had some hand in making you safe. I don't know. Okay, but public safety is a function or program. Okay, and then we form organizational units to carry out the functions. For example, fire and police department combine to carry out the public safety function. So you've got organizational units carrying out the government function and programs, okay? And then you have activity. So you could put labels on your expenses that call out the activity. And then unfortunately, the book stops with examples, okay? So I'm just gonna put patrols, okay? So the police do patrols. I still have a friend, he used to be, he's still my friend, he used to be a police officer for the city of San Jose. And we'd be sitting, watching football or something, and all of a sudden he'd go, oh, and I'm like, what's the problem? He said, oh, I have to do patrols tomorrow. And I'm like, well, what's that? And he says, well, I have to ride around to all the seedy motels and scan the license plates. And if I get a hit, I got to go knock it, find out who's in, get this guy to come, and I got to go to the door and arrest the guy. And it's a whole thing that he hated. Well, that's an activity that is, part of the public safety function being carried out by the organizational unit of the police department. Okay. Character, okay, is basically going to talk to us about the presumed period of benefit. Okay, so if we put current as a label on the expenditure, that means it's going to benefit, the current period. Remember, when we buy a capital item, we treat it as expenditure, right? There's no long-term assets. You buy police cars, you debit expenditure, but you can't put a label on there that says expenditure capital outlay. Now somebody's saying that that's an expenditure, but that you spent it on a more durable item. Debt service, when you pay principal and interest on debt, because there's no long items, both principal and interest payments are considered expenditure, but you can put a label on there that says, hey, debt service, or you could even put interest expense on there, or principal expense. And if you do that, then you're basically using an object class approach. And the object class basically is like a chart of accounts. You can even put that down, chart of accounts. Okay, so what I want you to do with this stuff, guys, is just, flashcard the different potential classifications and maybe put in the little examples that we have here for that. And that should be fine to help you to get any points for one or two questions they might ask you about that. Okay. All right. Now, again, as we've said, when you purchase a fixed asset, okay, you purchase police cars, you debit expenditure, and you credit cash if you pay cash. If you don't pay cash, you're going to pay that at a later time. We use the term vouchers payable. All a voucher is a control document. Okay, so if this is a voucher, and there'd be expenditure 1 on it, expenditure 2, they would list the amounts as well, expenditure 3, whatever. And then there's, a signature that somebody has approved that. So it's like accounts payable, but we don't call it accounts payable in government. We call it vouchers payable. Okay. All right, good. Now, when you come over to the next item, the debt. I'm sorry, your question? When we take a look at the debts, okay, let's look at that. Okay, so what happens? If we issue bonds, let's say, and governments do issue bonds, right? Cities, states, counties issue bonds. And if we issue bonds, of course, cash is going to come in. So we'll debit cash, but we don't have long-term debt. It's current assets, current liabilities. There are no long-term items on the balance sheet. So we credit other financing sources. Okay. Now, this other financing sources, okay, you come down, okay, and other financing sources is going to be reported on the statement of revenues, expenditures, and changes in fund balance. So remember, we said that other financing sources are sort of like a non-operating item, okay? So when you come over, let me get out of this again and back to the textbook, back to chapter 9. And now we're looking at the statement of revenues, expenditures, and change in fund balance. So you have revenues, right? You have your expenditures. See how they're calling them out current. They used current there, so that gives us the character. And then they started calling them out by what? By program here, by function and program, but then they flipped over and went back to a character for capital outlay. So you see how you kind of have your options as to how you're going to use those different labels that we saw for expenditures. And then when you come down, okay, we have the other financing sources and uses, okay? And what I want you to do with this one is go ahead and let's see, I want the pencil, I guess. What am I gonna do? Let me just go back into full screen mode, then I'm gonna have to come out. Okay, what I want you to put, oh, you can't put it here yet because you maybe don't have your book open to this, but when we come back to this, I'll remind you. But I want to flashcard here what are the two other financing sources? What are the two other financing sources? That's the flashcard, okay? Answer is transfer in and long-term financing. Okay, and you can see transfers in right there. Okay, you can see the transfers in right there as another financing source. That's the transfer in right there. Okay, and then they didn't show it here, but that $1 million bond proceed, it would show in like a non-operating revenue coming in. Okay, so that's another basic difference between full accrual and modified accrual. When you take long-term financing, you don't put it on the balance sheet as a liability. You put it on the income statement like a non-operating revenue down there. Okay, now the other flashcard I want you to put in here, right here, okay, is what is the one other financing use? Okay, we have other financing sources, other financing uses. Okay, and the one is what? Transfer out. You see it right there. Okay, that's the only time that you're going to have a other financing use, which is like a non-operating expense, is when there's been money transferred out of this fund and into another, and it shows us a track down there. And we'll talk more about that. Okay, all right, good. So that gives us a sense of where those are. And so let's just go back now and get back into chapter 8. Okay, go back to full screen. Okay, good. All right, now when you come over, we start talking about leases. Okay, now lease is a term of long-term financing. So when you look at how they handle the lease here, okay, if it is a long-term lease, okay, you can look at this example, okay, and I point out this example to you because it's a little bit tricky and it can be confusing if you see a question, although I don't think that the exam is going to get all hopped up on lease accounting for government, okay? But it's worth, at least if you do see something, to have the opportunity to look at this example with me. So they have this lease, the photocopiers or whatever, and it's $25,000, and there's a 10% interest rate on that. And then they're going to pay that over 3 years, making annual lease payments of $10,053. Now, this is the part that's weird, guys. And so go ahead and you should flashcard this entry that would be made when the government signs the lease. You debit expenditure because we have no long-term asset. There is no long-term asset, so we debit expenditure. And because we don't record long-term liabilities, but we're engaging in long-term financing, you'll credit what? Other financing sources, right? When you buy equipment, you debit expenditure, don't you? So that's what we're doing here. And when you sign a long-term lease, you do what? You credit other financing sources. Okay, it just looks weird, right? When you're looking at debit expenditure when we're bond, credit other financing sources. It's a wash on the fund balance. There is no fund balance effect because the fund balance went up by the other financing source. It came down by the expenditure. The fund balance gets affected when you start to spend a current asset. When you pay the cash, then you go ahead and if you want to, using a chart of account type of approach, an object class approach is what they're using here for this expenditure, you can put the label principal versus interest. So that payment that you make out, it's all expenditure. Now the fund balance goes down because you spent a current resource, current financial resource. Okay. All right, good. So I'm going to go ahead and I'm not going to worry about if they're the one that's leasing the property. I think they went a little overboard with some of this. So let's just go ahead and turn to our first question down here. Our last question really for the chapter, but our first question for tonight.
We're doing number one.
Yes, yeah.
So what is the appropriation?
What is appropriation?
Yes.
Appropriation is, as we talked last time, approved spending. So a government cannot spend money unless they have an appropriation, legal authority to spend. They just passed a continuing resolution to keep the government open because the federal government's fiscal year ends September 30th. And so they passed another continuing resolution to keep the government open because you can't spend money unless you have the legal authority to do so. And it's become fashionable over the last probably now we're going, they first started doing this when Clinton was in, that they just don't pass the budget. The Congress just doesn't pass the budget. And so what happens is they shut down the government because they can't spend money unless they have the appropriation to do so, the legal authority to do so. So once they pass that appropriation, the government would debit whatever they think their revenue is going to be, estimated revenue, say, say 100,000. The approved spending is the appropriation, so they credit that 80,000. That's like estimated expenditures, and then they would credit budgetary control, 20,000. Now they do that at the beginning of the year, okay? And I'm reviewing stuff we talked about last time. We would do that at the beginning of the year, and then at the end of the year, they don't need these revenue accounts anymore. So they would, these budgetary accounts anymore, because the year is over, right? So now they go ahead and they debit budgetary control 20,000. They debit appropriation 80,000. I'm scribbling all over this question. And then they credit the estimated revenue for 100,000 to close it. And as we said, that debit to revenue sits there as a placeholder for when the actual revenue comes in. The actual revenue is a credit, and they can keep track of how they're doing against their revenue. They credit the appropriation, and I'm going to show you an appropriations ledger here in a little while. And with the appropriation, they credit it, and then the actual expenditures are debit, so they can see how they're tracking against their appropriation as the year proceeds. Okay.
Yes.
Okay, good. So with all that, I think everyone now had a chance to try that question. I was kind of giving you the answer to the question at the same time. So most of us got 73% of us got it right. But let's just go ahead and just take a look now in the context of the question. Ridge Township governing body adopted its general fund budget for the year ended July 31st, year one, composed of estimated revenue of 100,000, appropriations of 80. And you can see the journal entry that I asked you to flashcard. You've got to know this journal entry, guys. This is easy points on the exam for you. And they like to ask this kind of stuff pretty frequently. And I keep hearing, oh, governmental. And I think it's because folks are just not taking the time to learn these relatively easy things here. You debit estimated revenue, you credit the appropriation, you credit budgetary control. Okay, and then the next question, Ridge Township, same question, but now they want to know what should happen to the 20,000, and this is a surplus, right? If we have a situation where we have a deficit, which is almost the case for the government, the federal government.
Credit budget control.
Correct. We would debit estimated revenue for 80. We would debit bud control for 20,000, and then I'm just going to assume the appropriation was 100,000. So governments do deficit spending on purpose. They do it on purpose. They budget for it. That's why it's so annoying when they turn around and they say, well, we're not going to raise the debt ceiling, or they make, Biden and Obama walk through hell every time they want to raise the debt ceiling. Meanwhile, they've already budgeted a deficit that will necessitate going over the debt ceiling that they then turn around and say that they don't want to raise. So it's just very dysfunctional. And I feel like they think it's comedy, and it's not, because those have real impacts on the economic, status of the country. So anyway, okay. So what's the answer to this question too?
E.
Well, it says, what should we do with the 20,000 budgeted excess of estimated revenue over appropriations?
C,
C, it's credit to budgetary control, right? The revenue was 100,000, right? The appropriation was 80, so there was an excess of 20,000, right? That goes to budgetary control.
Oh, yeah, yeah, that makes sense.
Yeah. Okay. All right, good. Got to know that stuff, guys, and you got to know that end of year. When I say you got to know it, because you can't throw away easy points like that. So just make sure you've got that flashcarded. Okay, let's go ahead and put the poll up for this next one. Okay, guys, let's go ahead and take a look at this one. And when we look at this, most of us got it right, which is great. The answer is C. But there's a little bit of a problem with this question that I find annoying, in that they say here and they say, well, what should we report as tax revenue in our fund financial statements? And I'm like, well, which fund? Because if the fund is using full accrual accounting, which is the case in the internal service fund, the enterprise fund, then, you know, they would use full accrual and it would be a different answer. So they're making me kind of understand that if it's property tax revenue, that it's probably not one of those other funds, but they should just come out and give the example that it's the general fund that they're talking about here. Okay, but once we establish, well, we're using modified accrual accounting for our fund financial statements, I guess it's one of the funds, one of the governmental funds that's involved here, then we have to remember that what we take revenue when it's measurable and available, but available means that what it'll be collected within 60 days of the year end. Okay, now again, this question has another problem in that it doesn't tell us that the government uses 60 days, because 60 days is not written into standard, but that's a common amount of time that's used. But you'd have to kind of go with that and say, well, it must mean 60 days here, okay, as to when they'll still count it as revenue. So you pick up the collections, right, that collected in year one, those that are expected to be collected in the first 60 days, we start falling outside of the 60 days. And now you're not going to count these. And of course, if the revenue is uncollectible, then obviously you're not going to take that as a revenue. You reduce the revenue by the amount you think you're not going to collect. So the answer here that almost everybody got is 600,000. Now, when I look at this question, though, I like to say to myself, well, what would happen if this was being accounted for using full accrual accounting, say for our government-wide statements? Because when we have the government-wide statements, we're going to consolidate all of these funds and put them at the government-wide level, and we're going to use full accrual accounting. So let's just take a look at how this would work if we are saying we have taxes receivable of 700,000. We have what? We have the allowance of 10,000, right? And now for full accrual, as long as we're in the period in which the money can be used, we take the revenue, right? Okay, so now for full accrual, we would go ahead and we would just take the revenue here for the full 690. Okay, so you could see in the exam the same fact pattern in which they ask you, well, what should you do in the fund financial statements? What should you do government wide? So I remind you and I point you back to that. It was a tedious example where I went through and I said, well, here's the money and it's coming in different stages, right, for the property taxes. And we compared the government wide to the full accrual. Take another look back at that, because I could see that the examiners would want to ask you if you can take the same fact pattern and come up with the correct answer if it was full accrual versus modified accrual. Okay, good. Let's go ahead and let's look at this one. Okay, good. Let's go ahead. Looks like everyone's had a chance to answer this question, and we had some good turnout here for this one. Almost everybody got it right. But let's look at a little bit of test taking technique here for this particular one. So I just want to close this for a second. Now look at this, and they want to know what they should report as expenditures, okay? And they start telling me that they paid principal on long-term debt. So I look at that, and yeah, that's an expenditure. When you pay the interest and the principal on long-term debt, that is an expenditure, right? Okay. Then they say payments to vendors. And I look at that and I'm like, well, I don't know, what was the payment all about? Because it could be that in year one, they debited the expenditure for 500,000 and credited the vouchers payable, right? For 500,000. And then they don't get around until paying that until what? Until year two. And in year two, they debit the VP vouchers payable, 500,000, and they credit the cash in year two. Well, if that's the case, then for 500,000, if that's the case, then that won't show up as an expenditure on the statement of revenues expenditures, change in fund balance in year two. So I don't know, well, what year's expenditures were they paying here? Okay, so that bugs me. But then I come to purchase of a computer. Yeah, when you purchase equipment, that's an expenditure. So if you take 100 plus 3, that's 400,000, and they don't give me 400,000 as a choice. So now I'm like, oh, okay, well, it must have been this that they had debited expenditure and credited cash, right? When they paid that vendor, and that was all done in the current year, the year that's under the question here. And so when I add that 500,000 to the 400, then I get the 900. Okay. Okay, good. Let's take a look at question 5 here. Okay, let's go ahead and wrap this one up. And yeah, most of us got it right. Well, I would have thought this would have been a little higher, actually. Now that I'm looking, 55%, I would think we'd be up in the 70s at least on this. So let's look at this and let's talk through this a little bit. The answer is D. Do you record fixed assets in the governmental funds? Well, let me ask you this. Do you know what the governmental fund, which are the governmental funds? Okay, these are very basic things, guys, that you got to get down. Okay, very easy things. Don't sleep on governmental accounting and throw away easy points. It's 20 points and it's easy stuff. Okay, so don't sleep on this stuff. The governmental funds, GRASP, the general fund, special revenue fund, debt service fund, capital project fund, permanent fund, right? Those funds use modified accrual accounting. And under modified accrual accounting, we don't report fixed assets. There are no fixed assets. There's no long-term items. It's current items only. So if you don't have long-term assets, can you have depreciation? No.
No.
So when you look at this, you're like, okay, the capital project fund is the one that uses modified accrual accounting, so there'll be no depreciation. The other ones, the enterprise fund, the internal service fund, C, right, SE, GRASP, C, remember I sang to you, KIPPO, right, okay, use full accrual. So you look, and the S and the E in the mnemonic, the service, internal service fund, the enterprise fund, they use full accrual. And obviously they're going to have depreciation. I mean, these enterprise funds are huge assets, right? Like a water system, right? You know, water gets to your house. There's no little, you know, God doesn't wave a magic wand and it comes to your house. There's all kinds of equipment and stuff that gets that water to you. So obviously that gets depreciated. Internal service fund, if I'm a garage working on police cars, I'm obviously going to have assets. And then private purpose trust fund, we'll talk more about the fiduciary funds here tonight. But the private purpose trust fund is going to use full accrual accounting because it's one of the fiduciary funds in the mnemonic KIPPO. Okay. Okay, make sure you know that stuff, guys. I can't. I'm going to nag you about that here because it's easy points. Governmental is easy stuff. I'd much rather be doing this than sitting there doing a question on the consolidations or something. Okay. Okay, good. All right, guys, let's go ahead and take the break right now, and we will come back and you can grab chapter 9 and we'll start digging into that. Okay, so let's take about 10 minutes. What, 6:32? Something annoying like that. Okay. And I'm going to pause the recording, and my buddy Matthew is going to remind me to start it again, right?
Oh, I have a quick question, Fresher.
Yeah, sure.
Yeah.
Thank you. That would have been annoying, right? What we're going to do in this chapter 9 now is cover encumbrances, okay, which is, again, one of those areas that I think scares students. And so there's little fear of failure thing starts kicking in, and you don't really look at it enough. And then you're, end up losing some easy points. Okay, so we're going to talk about that. And then we're just going to start, and I'm going to sort of pick up the pace a little bit and go through and talk fund by fund about some things that they specialize in. And so we've been talking generically about the governmental funds. Now we're going to go through one by one and point out a couple of unique things about them. And then we'll get into our proprietary and our fiduciary funds. Okay. Okay. So let's just go ahead though and start with this discussion of the encumbrances. So what happens here? Well, remember, we have an appropriation and we can't overspend our appropriation. That's our legally approved spending is our appropriation. We can't overspend it. In fact, individuals that are responsible for spending government funds could be, liable for civil money penalties. They don't throw you in jail, but they could fine you if you were to overspend your appropriation. So in order to avoid overspending appropriation, we use something called encumbrances. Okay, encumbrance means that there's a claim against the appropriation. They call that encumbrance. Okay, so let's just go ahead and let's take a look at what they tell us here. Open purchase order represent an encumbrance or commitment of the available appropriations of the government. Okay, so in order for government managers to effectively monitor the degree to which they have used their budgetary appropriations, governmental accounting systems must reflect not only expenditures, but also the obligation to spend. We call those purchase orders. Okay, so let's just take a look at the nature of encumbrances, and let's just go straight down to this example. And this is an excellent example. And what I need you to do is flashcard this journal entry, because this is the journal entry that is going to get you a lot of points on the exam. This is a journal entry that is used every time a government issues a purchase order. So there was a couple of sanitation trucks, garbage trucks they wanted to order, and each garbage truck costs $45,000. Now they had an appropriation of $100,000, but they need to record the encumbrance so that they don't overspend that. So they go ahead and they debit encumbrance, they credit budgetary control. Okay, now that's when they order it. The trucks have not come in yet. Then the first truck comes in, and it comes in at a actual invoice price of $44,000. So what do? Well, we reverse the original encumbrance for the original amount. It was 2 trucks, $45,000 each. One has come in, so we debit budgetary control. We credit the encumbrance, essentially reversing the entry we made when we had ordered that for that one truck. And then you debit expenditure, credit vouchers payable for the actual amount. Okay, so you set up the encumbrance, debit encumbrance, credit budgetary control for whatever the invoice price was, or whatever the listed price was. When the invoice actually comes in, you reverse it for the amount you had originally set it up for, and then you debit expenditure, credit voucher payable for the actual amount. Okay, got to know that, guys. That is pretty easy stuff. I mean, it's not that hard to wrap your head around, but you know, it's something that you got to make sure that you're dedicated to a flashcard and that you're comfortable with. Okay, now let's just look at this appropriations ledger. Remember, I showed you the revenues ledger, and I said we'd show you the appropriations ledger later. So notice that when they get the appropriation, right, they have this 100,000. When you debit encumbrance and you put that debit in there, now you know that what? Now you know that you only have 10,000 of budget authority left. If somebody walked in and said, hey, I found a new truck for 15,000, we'd say, too bad, we don't have the appropriation for that, right? We've already committed. Now, when the first truck comes in, we put that credit to encumbrance, and for a split second, the budget authority comes back up to 55,000, but then you do what? Then you replace that with the actual debit on the expenditure, and when you do, now you see that, hey, we've got what? We've got 11,000 left of budget authority. Okay. Okay, good. Now you gotta, be comfortable with that stuff. But then we have that encumbrance that's still outstanding for that second truck that didn't come in. So if an encumbrance is still outstanding at the end of the year, then we will have to reverse the journal entry and include outstanding encumbrances in the appropriate fund balance classification. So you take a look here and notice that when the end of the year comes, okay, you close the encumbrance. So you always close all encumbrances by the end of the year. So for this one that hasn't come in, debit budgetary control, credit encumbrances, and then you go ahead and you debit the unassigned fund balance and credit a category of fund balance that shows that there's a commitment on that fund balance. You credit fund balance committed. Okay. Now, encumbrances will not be specifically detailed on the face of the financial statements, but may be disclosed. So notice they just simply said what? unassigned fund balance committed, they didn't use the word encumbrance there. Okay, so you can flashcard that. Flashcard the entry to close the encumbrance at the end of the year and set up the fund balance. Now, when you take a look at this example down here, okay, let's just look at the fund balance, right? We have cash, and all the cash is considered unassigned. And then we go ahead and we buy that one truck, and that one truck, we still got 56,000, and we're showing that everything is unassigned. But we know that there's a second truck on the way, right? So what do? By debiting the unassigned and crediting the committed, now when someone picks up our financial statements, they take a look and they say, oh, I see. You have what? You have 56,000 cash, but only 11,000 of that is unassigned. 45,000 is committed. And even though it doesn't say encumbrance, maybe somewhere you might disclose, that that's for an encumbrance, but you don't say that on the face of the financial statement.
So what happens if the second truck comes in at 46?
Then you better find, well, you'd have enough budget authority to left at that point. So you would debit the budgetary control for 45, credit the encumbrance for 45, debit expenditure for 46,000, and credit cash for 46,000.
Okay, thanks.
Yeah, because we still have budget authority. Now, what I thought at first when I heard your question, you were just going to say, well, what if you exceed your budget authority? Well, you better go find some more money somewhere. So, if we, geez, it's 1,000 more, but we're all out of budget authority, and it can happen. Then you probably would have to appropriate some money from the new year when it comes in, or go back in and reappropriate some additional money to be able to pay for that. Okay, it can happen. What you're trying to avoid here is this huge disparity between what you've ordered and what you have the budget authority. That's a problem. Okay, but if you're, in the ballpark, when I say the ballpark, within, reasonable amount, then you're fine. Okay, now, when the truck comes in the next year, okay, then you debit expenditure, you credit the voucher payable for that truck that you were waiting for. And the other thing you would do that they're not showing you here is you would also reverse this entry. So at that point, when that truck came in, you would debit fund balance committed and credit the unassigned fund balance. So they don't mention that part there, but you'd have to reverse this entry in that new year when the truck comes in, and then debit expenditure. And then you would simply put the year that budget authority came from. So it was, say, 2021 budget authority. We got this truck in 2022. We would just label it 2021. Now, if I paid some of it out of 2022's budget, so let's say the thing was 46,000, and I had to get some of that money out of the 2022 budget, then I'd have expenditure 45,000 for 2021, and I would debit expenditure 2022 if that was the budget authority I needed to use to get that additional $1,000. So you would actually label the year from where your budget authority came that you were spending, if you're spending some money from last year and some money from this year. And you can see that on financial reports of government entities. You'll see expenditure, and you'll see a year, and you're like, why are they putting a year on there? That's telling you what year that budget authority came from. Okay. Okay, good. We don't need to look at
So then the reversing entry you said that they didn't show is basically the reverse of the closing the budgetary. So you would be, did you say that you would be debiting the fund balance committed and crediting the unassigned?
Yeah, you reverse this.
Okay,
This
Got it.
one here, I mean, really, the whole process, they've truncated here, because really what you would do is you would, in the new year, okay, when the new year comes, you go ahead and you debit encumbrance for 45,000, credit bud control for 45,000 to put that back. You reverse this, debit fund balance committed for 45,000, credit the unassigned fund balance for 45,000. Then when the stupid thing comes in, you debit bud control for 45,000 and credit the encumbrance for 45,000. All right, and 45,000, and then you do this. Okay, so you'd put that, you'd put the budget, you'd put the encumbrance, you close the encumbrance, set up the fund balance at the end of the year. In the new year, you reestablish the encumbrance, take the stuff, put the fund balance back to how it was. And then when the stuff comes in, you go ahead and you record your budgetary control and your encumbrance, and then set up your expenditure. But the important thing is you must close outstanding encumbrances at year end. You got to close them. Okay, now one more thing that I wanted to point out. Where was it? Once you go ahead and outstanding encumbrances, corresponding reduction of unassigned fund balance. So that's what we're trying to accomplish there. But there was one other thing I wanted to show you. So it's up here. Come back up here for a second. Encumbrances are generally not used for reoccurring expenditures such as salaries, and you can put also on here interest payments. And the reason they don't use encumbrance for those reoccurring things in that, look, a government knows how much debt it has. So what it does is it appropriates enough money to meet the debt service. There is no need for encumbrance because you're going to be on a regular schedule of paying that, and you just appropriate what you need to cover your debt service. You appropriate what you need to cover your salaries of your employees. You know how many employees you have, you know how much they make, so you appropriate enough to cover salaries. You don't have accidental, hey, who's this guy? Why do we have to pay him? You know who they are, you know what you're going to pay them, and so you don't have to encumber for recurring expenditures. Okay, all right, guys. Very important. Oh, let me show you one other thing, and then I'll move on from this. When we look at this thing down here, right, and we did this end of the year thing right here, why don't you put here C page 19, okay, and let's just go to page 19. You guys okay? We go to page 19. And on page 19, we're looking at the general fund balance sheet, okay? And just so we're kind of seeing how we're starting to, you know, categorize our fund balance, right? So there's the unassigned, which is usually the largest amount. Remember, not inventory. And then this one, there's the committed for sanitation, right? That we had credited. So that's where it shows up. Okay, all right, good. I'm going to do a quick shout out to my buddy Tom Cox, who puts all this stuff together. There's something wrong with him that he sits there and makes all this stuff match up like this. I'm always just like, wow. Okay, so let's go ahead and let's take a look at this question. Don't get sick. Not allowed.
I've had a cough for like a month now. I think I just get allergies with that cold air now.
Oh, yeah. I spend most of the day, kind of looking at my stuff and not talking to anybody. And then when my class starts, I notice I've got like this cold sounding voice. I'm like, oh, where did that come from? I don't feel anything, but.
Professor, you did put up the poll, right?
I did. You're not seeing
Okay,
it?
yeah, I must have accidentally exited out of it.
Oh, okay. Don't worry. Thank you for the heads up. Okay, let's go ahead and take a look at this one. And okay, we got pretty good turnout on this one, but the answer is D. Most of us got it. The CPA exam loves to do this. They love to ask you the debit or credit. That's not your training. When were you ever trained to say, oh, okay, just give me one of the debit and credit, and that's good enough? So when you get a question where they're asking you for the credit on a journal entry or the debit, do the whole journal entry and then, find the right answer, because it gets a little confusing in your head. You're trying to think of the credit without the debit. So if they order stuff, what are they supposed to do? You debit the encumbrance for 100,000, whatever, right? You credit bud control, correct? Is that what you do when you order something? Gotta have that down. And then you look and it says, well, what do I credit? Bud control, okay? If you just try to think in your head, the debit or the credit, you're gonna make a mistake. If you write down the entry and then you look, okay, got it. Okay, okay, good. Let's go ahead and try the next question. Okay, guys, let's go ahead and looks like most of us have had a chance to try this one. And okay, we got about 60% getting it right. Something we're going to have to work on here, guys, is getting these encumbrance things down, because you're going to get a lot of questions here. It's pretty straightforward, but you got to remember those steps, right? So they ordered something with an estimated cost of 5,000. So we debit the encumbrance for 5,000, we credit budgetary control for 5,000. Then they say that they got an invoice with an actual price of $49.50. So when that thing comes in, you debit bud control for 5,000, credit encumbrance for 5,000, and then you debit expenditure for the actual amount, $49.50, and you credit cash, vouchers payable, whatever. Right? Okay. So when you do that, it says, what amount should Elm debit or credit to budgetary control after the supplies and invoice were received? Well, what did we do? We debited budgetary control for 5,000, didn't we? Which we debit credit, and we credit the encumbrance for 5,000, debit the budgetary control for 5,000. So the answer is what? D gets budgetary control gets debited for 5. Question? Okay, so you've got to boom, 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 got to know those steps. I had you flashcard those questions like this. These are the types of questions that people are whining about. Governmental, that they can't, I shouldn't say whining, because I'm sure they're trying hard and stuff, but you know what I mean, that they're going on and on about, that are giving them a hard time. Meanwhile, it's like, you get a few things down, this is going to be easy. Okay, good. Let's go ahead and take a look at inter-fund activity. Okay, so this is now funds transferring money to each other. Okay, now this gets a little nerdy here, and I wish the exam would not, get nerdy on us and jargonistic on us, but they do in this area, in which we have reciprocal interfund activity and non-reciprocal interfund activity. Reciprocal means each fund is getting something. Non-reciprocal means that only one fund is getting something from the other fund. Okay, so if you have inter-fund loans, that means the money's going to have to be paid back by the borrowing fund to the lending fund. Okay, so they call that reciprocal, because the money's going to eventually come back from to the fund that lent that money. So flashcard that inter-fund loans are reciprocal inter-fund activity. But let's just go ahead, and I'm going to kind of co-op the space down here. And let's say that the general fund, which is usually the one that's going to lend any money out to the other funds, is going to lend some money to the capital project fund. So in the general fund, they would debit due from capital project fund as CPF, and I'm just making this number up, 10,000, and credit the cash for 10,000. In the capital project fund, right, they're going to reflect that same transaction by debiting the cash, 10,000, and they're going to credit due to GF is general fund, not girlfriend, 10,000. Okay, due to general fund. So eventually the capital project fund is going to have to send that money back to the general fund in this example. Okay, now the other reciprocal activity is when there's a sale of water or sewer services by an enterprise fund to a city or internal service fund activities, okay? So now it's a service that's happening between the two funds. So if that's the case now, and let's see, I guess I'll kind of put this all down right here. If that's the case in the, say, general fund will debit expenditure for whatever the services were. Say they worked on some fire trucks or something for 10,000, credit cash for 10,000. And in the internal service fund, now I got that stupid arrow in the way. In the internal service fund, okay, in the internal service fund, they will debit the cash for 10,000 and credit billings revenue. So revenue, because they provided a service and they credit the revenue for 10,000. Okay, that's seen as reciprocal because, you know, each fund is getting something. The general fund is getting the service, the internal service fund is getting the revenue, right? Now, some of these transactions are considered non-reciprocal and transfers are considered non-reciprocal. And so what happens? I'm now just going to get the money from the general fund and I'm not going to have to pay it back. So if it was a transfer in the general fund, okay, so let me get the transfer down here. If it was a transfer, meaning that the general fund is just giving the money to one of the other funds, then the, say the general fund will debit other financing uses, 10,000, credit cash, 10,000. That other financing use, guys, remember it's going to show where? It's going to show on the statement of revenues, expenditures, and change in fund balance, right? Down there at the bottom. And the capital project fund, I'll just assume is the one getting the money here. They're going to debit cash, obviously, for 10,000 and credit other financing sources for 10,000. That's because they're getting that money in and they're not going to have to get it back. So it just washes through the statement of revenues, expenditures, and change in fund balance, but it's not a revenue, it's another financing source is the way to classify it. Okay, reciprocal, non-reciprocal, nerdy definitional thing. Just know that an interfund loan is reciprocal, interfund service is reciprocal, and interfund transfers are considered non-reciprocal. Okay, good. Let's come over and let's look. And we talked about this a little bit, quite a bit, I should say. Last time I gave you some examples of deferred outflow, deferred inflow transactions, right? And the first thing to know is that deferred outflows are sort of like assets, but not quite. So they have what? They have a positive impact on our fund balance, our net position, our fund balance, and they're reported next to the assets, but they're a little different than assets. Deferred inflows are sort of like, you know, deferred revenue, but not quite. Remember, I had that little butterfly chart that I showed you, and they're reported next to the liabilities, okay? And remember, we went through that whole big long example of the property taxes, and for practical purposes, we set it up as a deferred inflow, and then as we collected, it would come out of the deferred inflow. Remember that whole thing? Okay, and we kept it in deferred inflow until we collected it. Okay, well, if we fall outside of that 60 days, then, you know, those amounts for which we had, you know, put in our receivable for when we mailed out the tax bills, that would be considered deferred inflow. So where is that? Right here. Assets associated with unavailable revenue. Basically, when we're saying that we're not going to collect that for 60 days, we put that into the deferred inflow category. We don't call it a revenue if we think we're going to collect it more than 60 days. Okay, and you can look back at that example. I went through quite a deep about it for the detail there. All right, good. Let's go ahead then and let's just take a look at this next section, categories of fund balance. Okay, and we've really, it seems to me they should move this discussion up because we've already been talking about these categories of fund balance, but since it's here, let's look at it now. Okay, and so non-spendable fund balance, prepaid inventories, etc. Okay, restricted fund balance. Okay, when we say that the fund balance is restricted, that means that it has been restricted by outsiders, grantors, creditors. Okay, somebody says, hey, here's some money, but you have to pay me back. They're loaning us money. Well, that would be an example of a creditor restricting that money. They talk about legislation, but it's important that we call that enabling legislation. They should have put that in there, enabling legislation. And I've told them that 50 times, and my buddy Tom ignores me every time I tell him that he needs to put enabling legislation in there, okay? Enabling legislation is legislation that allows the government to take a tax to begin with. And so if enabling legislation said that this money that we're going to take the tax for has to be used for some specific purpose, you'd have to do what? To use that money for some other purpose, you'd have to go and change the entire law to have that money used for some other purpose. And so they consider that restricted. Now that is different than what we see here with committed. Okay, committed money basically says, well, look, we already have some funds coming in. We have tax funds coming in, but now we're going to go ahead and the highest decision-making authority, okay, the city commission, the legislature, whatever, has earmarked that money for some purpose. So let's say we're collecting tax money. We say, well, from now on, we're going to use so much of this tax money for improving the streets or something. Well, they've earmarked that money for that purpose, and that would be called out as committed. So in both cases, restricted and committed, the legislature is taking an action. But in one case with the restricted, the enabling legislation, it's the same law that said they could raise the money is telling them how to spend it. With committed, they've taken some legislation, but they're earmarking money they already had. They're not, just creating a new tax there. Okay, so that's the legislature, and then that's doing that. When they say the highest decision-making authority, sometimes students say, well, I thought the governor was the highest decision-making authority. Well, when it comes to earmarking money, power of the purse rests with the legislature. Okay, so that's why they say the highest decision-making authority in terms of spending. Okay, now assigned fund balance is basically where we have assigned but not formally committed. Okay, now that's the city managers that do that. Okay, so what does that mean? Let's say we're a school district and we sit here and we say, well, we're going to put solar panels up. So we start to, assign that money to put solar panels up, and then all of a sudden the, air conditioning breaks, the heater breaks, the HVAC system breaks, and say, well, that those solar panels we're going to put in, cut that. We're going to now go and we're going to have to update the HVAC system, right? So they can just change their mind. But if they had said, hey, we're planning to put in these, what I say, solar panels, then that money would be shown as assigned. If money is unassigned, that means that they have the authority to spend the money, but they haven't made any kind of commitment as to how they plan to spend that money. Only the general fund can have a positive unassigned fund balance, because all the other funds are there for some specific purpose. So how can they have a positive unassigned fund balance? Okay, so I want you to flashcard that notion right there, that only the general fund can have a positive unassigned fund balance. Just flashcard that right there. But let me kind of explain a little bit, give you an example as to what's going on there. So let's say we have a capital project fund. Okay. And let's say that the capital project fund has some $200,000 that it got from a bond issue. And so they have cash of 200,000. And they're going to build, I don't know what you could do for 200,000, but let's say, humor me, they're going to build a county courthouse for 200,000, right? So they're sitting there and they have cash of 200,000 from the bond issue, and maybe they have some available inventory, some sheetrock and some nails and stuff. Say that's 20,000. Okay, and then let's say that they have to do an environmental impact study before they can start building this thing. And the bond covenant says you can't use any of the bond money on you can't use any of the bond money on what they call soft costs. It has to be hard costs. Okay, so where are they going to get the money? Well, they go ahead and they order the study, and so they have an account payable, let's say, of 30,000. Okay, so they go ahead, they order the study, they get the study done anyway, and now they have this bill and account payable of 30,000. Now, when we get down to the fund balance, they'll show restricted fund balance. That says restricted. They'll say restricted fund balance. I don't know how much of an improvement that was. Restricted fund balance of 200,000. They'll show what? Non-spendable. I don't know why I have to keep writing FB, because it's all in the fund balance section, of 20,000. And then they'll show what? They'll show unassigned. And the unassigned fund balance is going to be what? A negative 30. Okay, so that's how they end up with that negative 30,000 down there, because they have some bill or something and they really don't have the money to pay that bill at this time. Now, of course, everybody's freaking out now. Where are they going to get the 30,000? Probably our friend, the general fund, will send that money over to the capital project fund so they can pay that bill, right? But if that hadn't happened yet, then this would be the impact for a transaction like that or a situation like that on the balance sheet. Okay, now I want you to make your flashcard here, right here, but I want you to mark it up a little bit. Okay, so for this one, non-spendable is what? Prepaids and inventory, right? We've seen that a couple times. Restricted is what? Grantors, creditors, external, but squeeze in enabling legislation, Tom. It's enabling legislation. Committed, highest governing authority, establish limits. Okay, put the word earmark. The earmark funds, and that's the legislature. Okay, and then assigned, just put down city managers. And then unassigned, I've already asked you to make a flashcard up there that only the general fund can have positive, everybody else is negative. That's the key thing there. Okay, and the reason I'm having you write in what triggers these kind of things triggered is because the way I've seen the questions written, they'll say, the city managers have decided to use some money without a formal commitment or something. And so that will just trigger you, oh, okay, that's for the assigned. Okay. Okay, good. The other thing you could put on here is that these are all spendable. So these are all spendable. So there's non-spendable, there's spendable. And then the way I like to remember this sometimes is I just say spendable Racow. And Racow is, you know, this person that I used to hang out with would spend all his money on jewelry and stuff. Spendable Racow, okay? Or remember it however you want to, I don't care. Okay, but make sure you know the categories. Okay. All right.
So did you say restricted funds are spendable?
Yeah, they're spendable. Yeah,
Okay,
yeah, they're spendable because they're pretty much cash, right? I mean, you got the cash to build the county courthouse by issuing a bond, so they're spendable. But they're spendable because you can't issue bonds, right, to build a county courthouse.
oh,
And
I
you
see what
take
you're
that-
saying. Yeah, I
you
got
take
it
that
now.
money and say we're going to do something else with it, so that's why they call it restricted.
I see. Spendable is because it's not in a form where it can be spent. Got it.
Well, it is in a form where it can be spent. Yeah, it's cash.
No, non-spendable is what I said. Is
Non-spendable.
in a form that can't be spent. It's not
Correct.
money.
Exactly. You can't go to Safeway and say, well, I got a few months left on my insurance policy, so here, right? So prepaids. Okay, good. Let's go ahead then and take a look at a couple questions. Oh, we need the poll, of course. Okay, guys, let's go ahead and take a look at this one. Looks like most of us had a chance to try it. And okay, good. We got about 70%. And again, this is one of those kind of, you know, just nerdy questions. They want to know, can you call out the one that is reciprocal, the total reciprocal? And we have what? We have this billing by the Internal Service Fund for service. That's a reciprocal. Transfers are what? Transfers are non-reciprocal. So only the 5,000 is reciprocal. I don't know why they got to ask stuff like that. I think that's kind of stupid for them to bother you with that, but okay. Okay, all right, good. Let's take a look at this next one. They were talking about taking governmental off of the 2024 exam, is what they were saying. But when they went out to firms and got, some input about, how the exam should be structured, there was a huge backlash against not taking governmental off, because there are firms that have quite a bit of governmental business, and so it will live on. But I think some of these things they could take a look at. I don't know, that you got to know the difference between a reciprocal and non-reciprocal transfer. Anyway, okay, let's go ahead and let's take a look at this one. Okay, guys, let's go ahead and take a look at this one in the poll. And yeah, most of us got it right. This is the example of the deferred inflow, because we're sitting here and we're saying, hey, we're going to collect these revenues more than 60 days after year end. And if that's the case, then we can't put it down as revenue yet. We have to wait until we actually collect it in that next year and show it as revenue. We had that sort of long example that I gave you last time. Okay, good. Let's try this one. Okay, looks like most of us have had a chance on this one, so I'm going to go ahead and end the poll. And looks like just about everyone got it right. it's restricted. And you can see now why I had you write in the word enabling, which they never put in there. But that's a key piece of information there to be able to answer that correctly, that this money, what did I say, committed? This money is restricted because it's from enabling legislation. So the answer is B. Okay, good. Let's go ahead and let's look at this next one, then we'll move into the general fund discussion. Okay, I think most of us had a chance to look at this one. I want to spend a lot of time waiting for this. Would be a fairly quick question for you. See, well, doesn't want to let me. Okay, there it goes. Okay, and so most of us, everyone got this one right? Only the general fund can have a positive unassigned fund balance. Choice A. Okay, all right, good. So now what we're going to do is start to talk about each of the funds individually, okay? And I'm going to pick up the pace a little bit here because we've now understood the basics of government, how the governmental funds account for things, right? So we've understood the budget, the actual activity. We've called out some of the key differences between modified accrual and full accrual. We've understood the encumbrance process, and then we kind of went through and had some definitional things like the reciprocal, non-reciprocal transfer, deferred inflow, outflow, all that good stuff. So we've really kind of already talked about these, but there are a couple of things that are special about these different funds that we're going to take a quick look at here. Okay, starting with the general fund, which is the G in GRASP. Okay, and when you take a look, coming to the next page, right? And we use modified accrual accounting. Of course, it's one of the governmental funds, right? And so we have that, learned that last time, that we use modified accrual, and we've been studying and looking at the budgetary accounting. There's only one general fund, okay? And we're going to learn about major funds next time. But it is always considered a major fund, and we'll talk more about what constitutes a major fund next time. Okay, when they prepare their financial statements, they have a balance sheet and a statement of revenues, expenditures, and changes in fund balance. And remember, we looked at the structure of those last time, and I had you flashcard what the structure of those two statements look like. Okay, you come over and you know, I keep asking Tom to make sure that he puts current assets and current liabilities on here, but maybe he wants me to have something to do, so he doesn't like to put it on there. But current assets, current liabilities, don't forget that, right? And then when we look at the balance sheet, you can see we have the inventories like we talked about, all those current assets, current liabilities. We have our fund balance. We have what's non-spendable, committed, and then the positive unassigned. And don't forget, guys, the required format for the governmental funds, all of them, their balance sheet, this is the general fund, are to add the liabilities and the fund balance together to total up to the assets like that. You got to show it that way. Okay, good. You come over and you look at the statement of revenues, expenditures, and changes in fund balance, revenue, expenditures, using a character, program, chart of accounts approach here, right? And then our other financing sources and uses section. And remember, we have only the one financing use, which is transfer out, and then we have the two other financing sources, which is the transfers in and long-term debt financing. Okay, all right, good. Special revenue fund. Special revenue fund is a fund that is set up to generate revenue that will be used for a specific purpose. For example, I think I gave the example gasoline tax being used for road improvement. Okay. Now, when you come down and you look, the activities of the special revenue fund is that it's expendable. It's expendable, meaning that expendable, when they're expendable like that flashcard, that means that they spend both principal and interest. Okay, they spend both principal and interest. They spend all the money. The permanent fund that we'll talk about here in a little while is only allowed to spend interest and not principal. Okay, okay, good. Come over, and when you look at the financial statement, I guess they didn't show a balance sheet here, even though the special revenue fund would prepare a balance sheet. They didn't show it because I guess they figured the heavy hitter is the income statement, because we've got the revenues coming in, and then we spend them for whatever the special revenue fund was set up for. Gasoline tax is the revenue, spending is the road improvement. Okay, all right, good. Come over and look at the debt service fund. Debt service fund is an interesting fund because its name tells you what it does. It pays the principal and interest on general obligation debt of the government. So when the government issues the bonds come in, they spend the money to build a county courthouse. Well, guess what? They have to pay that money back, don't they? That's why in the 90s, there was this big movement, used to bug the hell out of me. They would say, do you vote to set us to issue bonds for, $10 billion to build prisons? And the big thing was, yeah, you got to vote for this. And, if you don't vote for this, you're not tough on crime because you're not, voting to spend $10 billion on prisons. Now, how much sense does that make? Let's go ahead and spend money, right, that we're going to have to pay back with interest, right, on a long-term basis to make an investment in prisons so that, we now have to have someplace to put these folks because we now have to have people to put in those prisons, I should say. So, and then these prisons are run by commercial enterprises. So the whole thing is just sick, right? So when a government borrows money, they are going to have to what? They're going to have to collect money to pay back that principal and interest. So that's basically what the debt service fund does. It's created to account for the accumulation of resources and payment of currently due interest and principal on general long-term debt. Now, what's important though here, what I want you to flashcard, I guess the other part's important, you understand what the fund does, but what I want you to flashcard here is it will only raise the money to pay back the principal and interest and account for that in the debt service fund for the governmental funds, for the GRAS funds. The internal service fund, the enterprise fund, all the fiduciary funds, they are using full accrual accounting. They will account for their own long-term debt. So this only happens, they only account for the debt of the governmental funds. So flashcard that, okay? Now, when we take a look at the money that's coming in to the debt service fund, most of it is transfers that come in from other sources. For example, if we're sitting here and the debt service fund is receiving some money from the general fund, I guess here, they would debit cash and they will credit. And guys, again, I asked Tom to put in here other financing sources every time, because I'm like, hey, the students are still learning and we want them to understand it, and transfer in is another financing source, and he doesn't want to put it there. So that's another financing source, transfer in, right? Okay, now you come over and we're going to see an example on page 34 where the capital project fund is going to be sending some money over to the debt service fund to pay for some bonds that the capital project fund had to have issued. And when they do that, they will debit cash and they will credit other financing sources. That 80,000 is because in this example, they issued those bonds at a premium. And often the bond covenant will read that the bonds are to be issued at a premium, and that premium is to be set aside for the protection of bondholders. In other words, that money's got to go over the debt service fund to be there available to pay the principal and interest as it comes due. Again, money getting transferred here again from the capital project fund. And hey, you know, I guess it's fun to see transfers 3 times here, because it's always transfers, it was all other financing source, right? Money coming in. Now, the debt service fund doesn't just put the money into a mattress and then hope, you know, that they have enough money to pay the principal and interest. They're going to do what? They're going to invest those funds, and then they'll have some investment income that will come into the debt service fund. And so that would be the journal entry for that.
Excuse me
Okay.
about one thing. When bond proceeds are issued, do the proceeds go into the debt service fund first and then go to the general fund or the projects fund or whatever the money was raised for fund? Or do they go into that fund first and then parts of it slide into the, are transferred into the debt service fund? I'm confused about that.
It goes to the fund that the money was for, so they have the money to spend it. So in the capital project fund, if they're issuing bonds to build a county courthouse, whatever, they're going to spend that money out of the capital project fund. But some amounts can come to the debt service fund if the bonds were issued at a premium, for example.
Okay.
The legislation will say, well, any premium has to be used for the protection of bondholders, which means send it over the debt service fund, so the debt service fund has that money to pay back the principal and interest. In this example, what happens is they're not ready to start spending the money yet in the capital project fund, so they invest it and they get some interest earnings. Well, often the bond covenant will say, well, if you invest funds and you earn interest on that, that money's got to be sent to the debt service fund. So that's what this is showing, is money.
Okay, but the actual proceeds and then the investment of those proceeds, say if construction hasn't started yet or it isn't time to spend all the money, that would actually be generated in the capital projects fund, and then the interest earnings would go to the debt service fund, correct?
Correct. In this
Got it.
example, you know, and there could be, you know, as I'm sure you're aware, a multitude of arrangements, you know. That can
Yeah,
happen.
yeah,
But
no, and
this
it would
is-
depend on the debt service, and it would depend on what the bonds were raised for and all kinds of other stuff.
Yeah, but they're pretty careful these days about, you know, they don't want, you know, they don't want a situation where you issue bonds and then you start taking that money and doing something like investing it. In fact, the federal tax law is that you would actually have to pay taxes on money that you were, if you were to invest that money and earn interest, you actually have to pay tax on that, even though the bond interest is not taxable for income purposes. They could make the government pay tax if they're just taking that money and they're able to have a nice low interest rate on that money because it's, you know, tax exempt. at the federal level, the federal government doesn't want them just issuing money, investing it, and making a profit off of that arrangement. So they got to be pretty careful in how they do that.
Got it. Thank you.
Mhm. Okay, you come over and you take a look at the expenditures out of the debt service fund, okay? And it is easy points on the exam, guys, to realize that both principal and interest are expenditures. Payments of both the principal and the interest are expenditures. Easy points. They want to trap somebody there and make you lose easy points. So in this case, when we paid the interest, that was expenditure, okay? And then when we paid back principal, that was also what? That was also expenditure. So both principal and interest are expenditures, okay? Now, both principal and interest expenditure should be recorded when they are legally payable per the bond agreement. So principal and interest are not accrued during the reporting period. So I think I gave you that flashcard last time, but remember, if you issue the bond January 1st, and then the interest is going to be paid in January 1st of the next year, the good accrual accountant in you is going to say, well, I have to accrue the interest at December 31st. No, the interest expense would be 0 at December 31st, and then you would record that as interest expense in the year that it actually comes due. Okay. All right, good. Come over and let's just take a look at the next page. We don't need to review closing entries again. We've had some practice with those already, but I want to look at the financial statement, balance sheet, and statement of revenues, expenditures, and change in fund balance. All the governmental funds prepare those two statements. It's current assets, it's current liabilities, it's fund balance. Okay. Okay, good. Statement of revenues, expenditures, and change in fund balance. It's revenues, it's expenditures, it's other financing sources and uses. And you're saying, why are you going so fast? Because it's the same thing for every one of the governmental funds. They look exactly like this. Okay. All right, good. Let's go ahead and let's take a look at a couple questions.
Man. I don't know how my mute keeps coming off. I don't be taking it off.
Yeah, my Zoom was acting up earlier when we were starting class. So I don't know if there's some snafu with Zoom tonight.
Yeah, I'm not trying to be rude with the cough. My mute just keeps automatically coming off. That's all.
Yeah, no, I understand. Okay, guys, let's go ahead and let's take a look at this one. Don't forgive me for being rude and not saying Gesundheit. Oops, shit. I forgot to share the results, so I don't know how we did on that one, but that's okay. Don't worry about revoting. So let's just take a look. Let me close that poll at this question. In the poll. Okay. Let's take a look at this one. Brandon County's general fund has the following, blah, blah. Now notice here, guys, they're asking you about the general fund, right? Which would imply, oh, I better study the general fund. No, this would be the same for all the governmental funds, right? So all the governmental funds use the same approach here. And they want to know which of these should be for the general fund as other financing sources and uses in its governmental funds. Well, we have the transfer, payment to the pension trust fund, and purchases of equipment are what? Those are both expenditures, not transfers, not other financing uses. Okay, so the answer here is 100,000. The payment to the pension trust fund, guys, it's like making a payment of salary. You debit expenditure, you credit cash when they make the contribution. So in the general fund, they'll debit expenditure for that pension payment. This is 500,000, credit cash. And then in the pension fund, they'll debit cash for 100,000 in credit revenue. Now, what's interesting to me is when they ask questions about the pension fund, which is one of our fiduciary funds, it's generally asking you the accounting in the other fund, in the contributing fund, and not asking you the accounting for the pension fund itself. So, okay. All right, good. Let's look at this one. Okay, guys, let's go ahead and take a look at this one. And yeah, most of us got this right. The answer is D. The debt service fund would account for that money as it's being set aside for paying back the money that was borrowed for these construction. The capital project fund is going to do what? They're going to account for the actual money that comes in and then gets spent on the capital projects itself. Okay. Okay, good. Let's go ahead and let's take a look at the next question. Okay, let's go ahead and look at this one. I think we've had enough time on that one. It's a pretty quick question. Okay, a little bit of trouble with this one. Again, the debt service fund does not account for paying back the principal and interest on anything other than the governmental funds. It does not pay back principal and interest for any of the either of the proprietary funds, any of the fiduciary funds. Only. Okay. All right, let's look at the next one. Okay, guys, I'm gonna go ahead and end the poll. And you're saying, well, John, I'm still working on it. And part of the reason I'm ending the poll is to stop torturing you. Because when you look at this question, okay, and most of us got it right, they're basically asking you, how much interest should be accrued when you issue bonds on January 2nd and the year end is September 30th. And you get all excited because you're a good accrual accountant. You're like, oh, okay, I think I got this. And you launch in and start trying to work on this thing. And the problem is that they tell you the interest is payable what? The beginning of the following year. We do not accrue interest in between interest payment dates in governmental funds. And so the answer is 0. Sometimes students say, well, that's a trick question. It's a trick question that you should pray that you get on the exam, because this gives you, bunch of extra time now while some candidates are sitting there messing with this question, trying to find the numbers, and notice they don't make it come out nice and even. And then all of a sudden, you're home and you race in 2 or 3 minutes. Meanwhile, you're worked 2 questions while someone's messing with this. Okay. Okay, guys, I am going to adjourn for tonight. We will pick up with this next module dealing with the capital project fund next time, and we'll just continue to press on here. But you should be able to finish up chapter 8 now and get through those first couple modules of this chapter 9, which I think tend to have more questions in those first couple modules than some of these back modules. So you should be able to get a good chunk out of your homework this weekend. And then I will see you on Thursday. Matthew, you got to go get you some Alka-Seltzer Cold Plus or some Robitussin or something, man. You can't be sick.
I forgot about that good Alka-Seltzer Cold Plus.
Yeah, that's the when I get a cold, I like that stuff. I don't get colds that often because all those years I spent as a housekeeper in the hospital. So I think I got exposed to every virus on earth. So these viruses see me and they just kind of yelp and turn around the other way. But yeah, when I get something though, I like that stuff. So
Me too.
take care of yourself.
Thanks.
Okay, guys.
Thank you.
All right,
Take
thank you.
care.
Okay, see you next week.
Thank you.
Okay, good night.
Hey, John, I just had a quick question regarding the class.
Sure, let me stop the recording first, just so we just have to record that.